Thank you, Mr. Chairman. Mr. DeMarco, last fall the FHFA and the Treasury Department agreed to a change in the structure of the dividend calculation. And as a part of that, under the new agreement, all profits except for a small amount retained for capital are remitted to the Treasury Department, or to the Treasury. Some have argued that this may have created incentives for Fannie and Freddie to assume either more or less risk in a given transaction because they don't possess normal business incentives. You've been dealing with the unintended incentives within the GSE space since even before the conservatorships began, but are you anticipating any new steps that may be needed to ensure that the taxpayers remain protected?
I am not, Senator. I'm not concerned about that particular risk. I think that the management team and the boards at Fannie Mae and Freddie Mac are quite anxious to demonstrate to the American taxpayer that they have made great strides at each company and that they are operating these companies in conservatorship profitably and safely. They recognize their responsibility to the American taxpayer, and I think they take that responsibility quite seriously. I don't think that they anticipate or have any envision of increasing the risk-taking. And in any event, I've got a solid supervision team at FHFA monitoring the activities at each company, and we would be quite mindful for any increase in risk-taking activity at the companies.
Well, thank you, and I appreciate your attention to that. On another issue, in my opening statement, I reiterated concern about the massive stake the federal government has and continues to have within our mortgage markets. The obvious solution for this is for Congress to act on reform. In the absence of congressional action, you've established a reduction in the footprint of the GSEs as a fundamental goal over the next year, and I'm very happy to see that. Please describe to us in more detail the risk-sharing and portfolio reductions targets that you're establishing.
Certainly. Fannie Mae and Freddie Mac have three principal lines of business: a single-family mortgage guarantee business, a multifamily business, and a retained portfolio in which they buy and hold mortgages and mortgage-related assets. What we have done in the 2013 scorecard is set objective measures for each of these lines of business to fulfill the strategic goal of gradually shrinking their footprint in the mortgage market. So with regard to single-family mortgages, what we have described is a goal of having $30 billion worth of unpaid principal balance of mortgages to see some kind of risk-sharing or risk transfer transaction between Fannie and Freddie and private capital. This could be done accomplished a number of ways. The chairman asked about mortgage insurance, so one way to do it is to have mortgage insurance companies provide an insurance wrap on a mortgage-backed security. Another way to do it is to issue something called a credit-linked note, some kind of credit-linked security, in which there's a reference pool of mortgages and investors pay in money, and that serves as sort of real equity backing the credit risk there, and they get a return on that from the guarantee fee, but that money sits there in trust to absorb losses in the mortgages. And the third principal way is through a senior subordinated security structure. This is pretty standard in the asset-backed securities market. It's how Freddie Mac operates its multifamily business, and what you do is you issue you take the pool of mortgage securities and you break it up into two separate pieces. One piece is unsecured or it's unguaranteed by Fannie or Freddie, and so if there are credit losses, those are absorbed by the holder of that security. So that's what we're doing in the single-family space. In the multifamily space, Fannie and Freddie already do virtually all of their lending on a risk-shared basis with private capital. So our approach to gradually stepping back their footprint there is to say we want to see your size in the marketplace in 2013 be 10% smaller than it was in 2012. We actually expect the multifamily market to be a bit smaller in 2013 than in 2012, but I don't want to see their market share growing at a time that we're shrinking the companies and the market itself is shrinking. Third area is the retained portfolio. With the retained portfolio, the Treasury agreement already calls for a reduction 15% year over year in the retained portfolio. What we've done is said, look, we're going to be able to meet that target the next couple years just through normal runoff. We can do more than that. So we're looking at the illiquid portion, the non-agency security portion of that portfolio, and we gave each company a target that they must sell 5% of the non-liquid assets that they had at the start of the year. They have to do that over the course of the year. How they do it, when they do it, which assets they do it, that's for management's judgment to make good business decisions in light of the market circumstances.
Thank you.